Yeah, I discussed that we're actually dealing with from here to here. That's the range we're actually dealing with. Let's go back to the chart. Let's go back to the chart. So a 1 hour chart, this is the range we're actually dealing with from here up to here. So we still go and get the markup. Still go and get the markup so that we create. This is it. This is the range. This is the daily range we're actually working on. This is the daily range we're actually working on the 1 hour time frame. Recall that we have this to play with. We have this to play with. We are coming out from somewhere. We have this to play with. This is the range we have to play with from here to here. This is the last push that we have. Once we have this, once we come to this particular point, we know that it will hit and then come back. Then that is where the algorithm will switch. You understand? So now when you come to this particular point, this is the range you're actually dealing with. You remember that this is just a consolidation market. Now we'll go down to a lower time frame so that we'll understand what the market is doing at the immediate spot. Let's get to 15 minutes. Let's get to 15 minutes. Now if you look at this chart from here, you will understand that this was a structure. The market pushed and manipulated. This is the resistance. You see another resistance this side. This is the resistance. This is another resistance. It formed double top, and the market smashed it. When the market smashed it with this, what then do you have? What then are you looking at? What then are you expecting? When the market smashed it and moved up, what then are you expecting? You should be looking at the market to come and clear the liquidity down. And if the market coming to clear the liquidity down, you see that you have another range here. You see that you recognize that you have another range here. Let's do it. You have another range from here to here. This is another range. This is the range that actually produced this particular. This was just a manipulation. So with this range, where are we looking at? We are looking at the market to return to this particular place. When the market returns to this particular place, then that's where we begin to deal with the market again. But remember, you don't actually just go first before the market. You allow the market to show itself. That is the psychology. That is what a professional trader does. You don't just push yourself into the market. So when this market, you look at this push. This was just a retracement. When did it retrace to? It retraced to come and it offered it come here and manipulated it. We are going to look at the moment I saw this and saw this and saw this and was seeing the moment I saw this, I realized that the pressure of the market is now to the downward. That the market, since it has manipulated it, that the market is more interested in coming down to this particular place. Meanwhile, this particular place will be internal liquidity too. But then we deal with the market based on ranges. You know, I'm teaching you mitigation ranges, daily trading ranges. I'm teaching you daily trading ranges. Now, when the market returns to this particular place, what are we looking at? This is the range we're actually looking at from here to here. Now, let's deal with this market from here to here and understand. I am trying to make sense out of these markets to show you how the market is booked. To prove to you that the market don't just book. The market is booked on certain algorithmic sentiments. Look at it, we pick our Fibonacci. When we pick our Fibonacci and measure this range from here to here, you take your 50%. When you take your 50%, let's go. We take our 50% from here. When we take our 50%, then we pick up this Fibonacci and mark up our 50% up and take another 50% again. Take another 50% again. So you begin to understand that the market is not just booked. The market is booked based on certain algorithmic sentiments. You see how the market is respecting these ranges. Sorry. Market has done its daily it has reached its daily limit, then we should be looking at the market coming down. Where do we know our take profit? When you know your take profit is to take this range from here to here. You mark it up and you take it down. When you take it down, you use Fibonacci, mark it up and take it down. It will give you this. When it gives you this, this is the first take profit that you are going to take. You see how the market is coming into range. You see how the algorithm is defining itself. This market is not just booked based on that they will just want to book the market. The market is booked based on certain algorithmic sentiment, algorithmic statement. But then you have to be conversant with the market and understand what the market is doing at a particular stage. That's how you make money in the market and become a financial expert that way. And one thing you should understand is that once you have this knowledge, you cannot unhave it again. The knowledge will be with you forever. This is an order block for me. You remember I told you that the market has certain sentiments. It produces a fair value gap. After the fair value gap, it shows you an order block. Now look at the market from here. Let me show you something that will blow your mind now in the market. Look at what the market is doing here. The market is actually trying to tell you that they are not interested in coming down again. Look at, they created this internal liquidity. When they created this internal liquidity, what happened? When they created this internal liquidity, this is it. What happened? You have a fair value gap here. It came and mitigated the fair value gap. When the market mitigated it, it moved away. The moment it moved away from here, you understand that the algorithm is booking on a higher plane. Now, it came and created a double top. What is it telling you? The double top is telling you that the market will come down and come down to this particular place. When it came down to this particular place, you have a range like this. This is the range you have. Remember that what the market does is a push. The market does a push. It has a retrace. When it does a retrace, what happens? You have to have another push again. It is after this push that you expect another push down, another push up that will come down here, right? When it comes down to this particular place, then you divide this into two. When you divide this into two, you have half of this. Then this becomes an inversion fair value gap that will come and form here. This becomes an inversion fair value gap. When the market comes here, this becomes an inversion fair value gap. This fair value gap will then push the market to deliver down. Then this particular thing will become an inversion again. The market will have to come up. It will at times it does create an internal liquidity here, then comes down. After coming down, then you have a signature like this that moves up, then the market will go down. So I am trying to explain to you how the market is booked, but for the meantime, we as professional traders, we don't just go into the market. We expect the market to come to us. So we are waiting for the market to come up here. When it comes up to here, we have this. We have a daily opening gap. This will define the range of the market. The market will not break here. If it breaks here, then our analysis has failed. Then the market will be, if it breaks here and come up here and fails to break down, holds, then you know that the market is more interested in going up. For the meantime, we are waiting for the market here. Once the market comes to this particular range, we wait for the market and go inside again. This is on the 1 minute time frame. We wait for the market. We are going to implement, because our bias now is down. For now it is down. Once the market comes here, we expect the market to go down. Then we can trade from here. Then we will have a smaller stop loss above this, just briefly above this. Then we can actually take our risk from here. Is the market, for you to succeed in the market, you have to take calculated risk. You don't just enter a trade because you want to enter a trade. You enter a trade because you see the trade, it is nice, it is good to enter the trade, and you enter the trade. Guys, for you to succeed, I have the secret to the market. I have some certain things here I can show you. When I show you these things, you understand it and begin to understand the market from a bigger perspective and what the market is actually saying.